Hello, I'm Ed Crooks, the US Industry and Energy Editor at the FT. Over the past few weeks, we've been asking readers to send us their questions about the big stories in the world of energy. You ask, I answer. So let's get started. Michael D. wrote in with, all I ever hear about are the poor producers hurting from lower oil and gas prices. What about all the consumers who are greatly benefiting? The consumer benefits are massive, yet drowned out by the boo-hoo Crimea River producers. Now, it is absolutely right that consumers have been helped a lot by falling oil prices. It's estimated that cheaper fuel saved each American household an average of $1,000 last year. There were big savings for China too, which saved more than $90 billion on its oil import bill. The volume of crude that China imports has carried on rising, but the cost of it has fallen sharply. But in spite of that, cheap oil doesn't appear to have given much of a boost to the world economy. Forecasters have been disappointed by how weak the stimulus from oil appears to have been. And there are several reasons why that might have happened. Heavily indebted oil producers, both companies and countries, have been cutting their spending sharply in order to stay afloat. And consumers in the US and other oil-consuming countries are still traumatized by the great financial crisis and are saving a lot of the windfall. As fuel prices have fallen, US retail sales have certainly not taken off. And also, it's the classic problem when an economic change has widespread benefits shared by many people and sharply focused costs concentrated on a few. The losers always make more noise about it than the winners. That's probably the main reason why oil consumers' voices have been drowned out by the producers. A reader from the FT's Facebook page called Mrs. Krugerrand asked, what is the future role of OPEC? We're once again hearing a lot of talk about the death of OPEC. People say that the mighty cartel that once ruled the world is now falling apart. That's probably wrong on two counts. First, for most of its existence, OPEC hasn't really been as all-powerful as people often imagine. It did have a huge impact on oil markets in the 70s, that's true. But before then, in the 60s, it was powerless. And since the 80s, its influence has been limited. OPEC's influence was at its greatest when its market share was at its greatest. The peak of its power was when the cartel controlled more than 50% of world oil production. Today, when it has about 40%, it can nudge the market in one direction or another, but not control prices in a way that overrides fundamental market forces. And that's probably the way it's going to stay. OPEC's share of the oil market is, if anything, likely to rise a bit over time. It still includes the countries such as Saudi Arabia, Iraq and Iran that have the largest oil reserves with low production costs. But other sources, including shale oil in the US, will be viable competitors to OPEC for a long time to come. So you might think of OPEC's role in the oil market as a bit like a central bank's role in a country with a floating exchange rate. It can steer the course it wants so long as conditions are in its favour, but it can't push against the tide forever. And also via Facebook, Michael Stapleton asked, what is the exposure of US financial institutions to the oil industry? How long can these credit lines be sustained before defaults become a common occurrence? The US shale boom of the past dozen years was fueled by a sharp increase in debt, both bank loans and bonds, and US financial institutions were among the leading lenders. In the past week, we've seen several US banks raising the provisions they've set aside for oil loans that have gone bad. And already there's a steady flow of bankruptcies among US oil and gas production companies. They've been running at the rate of about one a week since last summer. But the exposure of US banks varies widely. If you look at the top 10 energy lenders in the US, you see names like Bank of America, Wells Fargo, Citigroup and so on. But for most of those, energy lending is only a small proportion of their tangible common equity, usually a percentage in the low teens or even less. There are, however, a few regional banks, including Comerica and BOK Financial, where the exposure is much higher. Those are the ones that investors and regulators will be keeping a particularly close eye on. The banks aren't keen to push companies into bankruptcy and have on the whole been quite lenient in their renegotiations of all companies' borrowing facilities. The longer oil stays low, though, the greater the risk that banks will feel they have no option but to withdraw credit more aggressively. If that happens, then the rate of bankruptcies will accelerate. That's all for now. Sign up to the Energy Source newsletter at fd.com/energysourcenews to keep up with everything that's happening in energy. Until next time, that's all from me. I'm Ed Crooks for the Financial Times in New York.